Hey, what's going on, everybody? Welcome back to Dapper Dividends, and check this out. I got this in the mail from NRG Energy, and I'm a weirdo because when I get stuff like this, I like to look and say, hey, I wonder if they're a publicly traded company that pays a dividend that is growing, and wouldn't you know it, they do pay a dividend. The impetus of this is the NRG Energy letter that spawned the idea for this video. So I looked up what they do, who they are, some of their numbers, and I saw something that really surprised the heck out of me, and I wanted to do a video and share it with you. So I found 4 other undervalued companies that have the same high profit margin, over 20%, that NRG, ticker symbol NRG, has, if you didn't guess that. So without further ado, these are going to be 5 undervalued dividend paying companies that have over 20% net profit margins. And why is profit margin so important? Because it shows health of a company. The higher the profit margin, the better. If a company has a 15% profit margin, that means out of every $100 that comes in, they are keeping $15 as profit. So to be over 20% is really, really a good sign. And obviously, the more profit that you're keeping, the healthier your company is. And it means that management is doing something right. So here we go. 5 companies that have an over 20% profit margin. Number 5 on the list is Industrial Logistics Properties Trust, ticker symbol ILPT. It's a real estate investment trust, or REIT, that owns and leases industrial and logistics properties throughout the United States. This is right up my line of work. This is in my wheelhouse. I am at these facilities all day long, every day. Been doing this for 21 years. I'm a welder, a service tech, an installer of commercial and loading dock and overhead door equipment. So properties like this that are logistics driven, very familiar with it. They do have a 20.8% profit margin. So $20.80 of every $100 that's coming back in, they keep that as pure profit. That's really nice to see that number. The dividend is at 5.84%. Current EPS payout ratio, 71%. And simply Wall Street's valuation, I've said it again, the reason some of these look so cattywampus is that they use a dividend discount model. They're projecting earnings out 10 years into the future and then discounting that back to a price today, which is what you see here. Why some of these you will see are looking sky high and way undervalued. Take those with a grain of salt because those are just analyst numbers, and yeah, nobody can really predict 10 years out into the future, but it's a number. It's something to get your brain thinking that this may be a pretty cheap price we're looking at here today. Number 4, Cisco Systems, one of my favorites. I love Cisco Systems, ticker symbol CSCO. Designs, manufactures, and sells internet protocol-based networking and other products related to the communications and information technology industry in the Americas, Europe, Middle East, Africa, Asia Pacific, Japan, and China. Why don't they just say the world? 21.8% profit margin. That is super stellar and super healthy for Cisco Systems. Dividend currently 2.94%. I was buying it when that yield was over 3%. Current payout ratio only 58%. That's really safe and solid. That gives me a warm fuzzy, and I think I need to pick up more Cisco Systems going forward. The valuation is 24.9% undervalued according to Simply Wall Street. Love myself some Cisco Systems. By the way, check out the logo. You know what that is? That is the Golden Gate Bridge in San Francisco Systems. And now you know. Number 3 on the list is Oracle. Oracle, ticker symbol ORCL, is a corporation that provides products and services that addresses enterprise information technology. A little bit of newsworthy with Oracle. They moved recently from Silicon Valley down to, I can't speak today. They moved from Silicon Valley down to Texas. Not sure where in Texas they moved to, but they're down there with Elon and Joe Rogan. They're all going to have a big billionaire party down there. So Oracle, what's going on here? 26.3% net profit margin, but the dividend's only 1.51%, so that brings it down a little bit in my valuation. So in the world of tech, 1.51 isn't that terrible, but we just looked at Cisco and saw they're almost at 3%, so I would much rather put my money into Cisco Systems. Oracle's payout ratio is currently 28%, so that is very low and safe, and they're predicting it to be 23% in 2024. The valuation currently 19.8% undervalued according to Simpla Wall Strat. And now the belle of the ball, the NRG, they sent me this fine paperwork trying to get myself to go with NRG, which NRG, hey, NRG, the NRG. We're going to call him NRG from now on. Just say it twice. It's twice as nice. And what's twice as nice about NRG is their 44.7% profit margin. K-Loco, they're keeping almost 50 cents of every 100, or 50 cents of every dollar, or $50 of every $100 that is coming back into their company. That is just awesome. I don't think I gave you the description of them. NRG, together with its subsidiaries, operates as an energy company in the United States. 44.7% profit margin. Dividend, 3.05%. They got over that 3% dividend yield. And the payout ratio, 7%. So I had to go to Yahoo Finance and do a little bit of a double check for the trailing 12 month. The trailing 12 month is a little bit higher, unfortunately, at 13% of their free cash flow is being paid out as a dividend. That is incredibly low and incredibly safe. I get this letter in the mail from NRG, and I think I'm going to be buying some NRG. So let's look at their valuation. They've got them at 78% undervalued. $193 is what they're saying the fair value. Again, take it with a grain of salt because that is in the near distant future. How's that for a play on words? 10 years out, they're saying it'll be about $193 is the fair value today. Currently at $42. I'm going to do a little bit more in-depth analysis for myself, and I'm really liking what I see from NRG. So this was a pleasant surprise that I'm happy to share with all y'all. And now, numero uno on the list is the one, the only, ticker symbol CTRE, Care Trust REIT. They are a self-administered, publicly traded real estate investment trust that's engaged in the ownership, acquisition, development, and leasing of skilled nursing, seniors housing, and other health-related properties. I don't know about you, but I know there's a lot of boomers getting up there in age, and they're going to need to be taken care of. So Care Trust REIT is definitely something that I think you should look into and think about, because we know a lot of our boomers are aging and they're not getting any younger and they're going to need that care. So, hey, why not be part of a company that's going to be taking care of the boomers in their golden years, and you can receive a nice dividend in the process. 44.9% profit margin for Care Trust. Care Trust's dividend is 4.31%. Very nice for a REIT. The payout ratio currently is 80%. The valuation for CTRE is currently about 43% undervalued according to Simpla Wall Strat. That's it. That's all, folks. That's a wrap. That is 5 undervalued, according to Simply Wall Street, dividend companies that you can consider investing into for some sweet, sweet dividends. And I've been Russ. You can find me at Twitter at RustyRam78, and Dapper Dividends I am on Instagram. Like Yoda, I shall speak and help you with investing in dividends. And that's all. I'm going to get out of here. I got some din to eat. I will talk to you in the next video.